Good afternoon, everybody. Welcome to TraderMerlin Show. It is your Monday edition. We're going to be focusing on the Fed today. I took some of the red out. Thank you, Michael Trammell, my photographer friend, for helping me get some of the color. I think I look more human now. I look a little bit sunburnt over the past couple weeks. Now I got this new camera, but I think we got it dialed in. Video should be looking much better, and maybe I'll get the audio dialed in someday. But so far, so good for today's show. We'll see how bad it gets by the end of the week. Anyway, we're going to talk about the Fed, anticipating their next move. That is the topic du jour today. So, we are faced with one of the more significant Fed announcements ever this Wednesday, and I'll dive into all the possible outcomes. There are really only three possible outcomes, as most of you probably are aware of. Rather than you have a 50 basis point increase, 75 basis point increase, or a full point. I think everything else outside of that, meaning 1.25 and higher, or anything below 50, I believe is off the table. We'll run through all those different scenarios, run through what happened in our market out there today, and more importantly, try to learn from what history has told us about this type of market condition and what the Fed's reaction and actions are accordingly. At this point, we should be forward-looking towards inflation, but it seems like we're in our rearview mirror looking at inflation. It's just, I don't know. We're reacting way too late. I'll say that. So let me just dive right into the charts here. I'm going to look at the markets real quick to start, and then we'll dive into the numbers. Start things off with what happened out there today. It actually turned out relatively nice. Most of the session, we were kind of hovering around unchanged to slightly negative for most of the market indexes, and then a late market surge pushed the indexes into nice positive territory. I sold some call options against some of my positions today as well to lock in some premium, and it's always nice selling options selling calls when the market rallies so you can get better premium for yourself there. Let's go. I look clean and professional, by the way. I think my hair is a bit messed up. Ooh, yeah, a good call, Katut. Just so I can plug my guest, because I normally don't do that. Given the fact that this week is all about the Fed, I think every market move and action you're going to have is anticipation about what the Fed's going to do. Wednesday, we're going to have David Warner on the program. David Warner is a Forex trader. He's got a focus class online Trading Academy, just a great Forex guy. You've seen him on here before. And then on Thursday, I'm going to have Bill Addis on. So it's currencies, it's bonds, it's interest rate all week here on TraderMerlin Show. It's like Shark Week. All right, let's start at the bottom, work our way up. Crypto still in a world of hurt, and I think this has a lot to do with regulatory pressure. There's a lot of talk about crackdowns, not only on what's a security, what's a commodity, but also energy consumption. I think that's hitting a lot of these cryptocurrencies rather hard. You can see there's really kind of hammer formation that formed on Bitcoin today as we tapped those lows yet again, actually making the lowest low we've had in quite some time today, hitting an intraday low on the futures market of 18,195. And for me, I've been saying if we get a close below 18,000, I think we're probably going to go to 13.5, and then from there 10,000. So really hoping this supports here right around 18,000. It did today, but we'll see going forward. Regulations are coming for crypto, and that could be a big factor. Now, gold on the day has a nice little hammer formation that it finished with. You can see the small little real body where it opened and closed right around the same price. Long bottoming tail, not bad. That looks good to me from a, hey, let's recoup some of these losses that we've incurred over the past week type of move. Of course, we talked on Friday's show about how do you trade a hammer formation. Well, you put a line right across the high of the day. Let me get some of these other lines out here so I don't confuse everything. That should do it. Put a line right across the high of today, and if we open up down below, which we will because it's the futures market, and then start to rally above, let's call it 1690, $1,690, then you got a nice potential long trade on. And some of these indexes actually worked out very well for that today as well. So that was gold, pretty much unchanged, 0.05% on the day. Crude oil was up 0.21%. Again, another really big hammer formation. The only problem is it's not at the bottom of a downtrend. It's actually forming a double bottom right now for those that love their chart patterns like me. I got to my addiction. I'm going to the Betty Ford Clinic for chart pattern recognition here soon. But you'll notice it's not a double bottom yet. We'll know it's a double bottom if it rallies up and gets above this line right about here, which is going to be call it $90.20. If we bottom, which we may have today, and we continue to rally on crude oil and get above 90.20, then all of a sudden you could contend we're in a double bottom situation and looking for higher highs, which would put us probably at about $98 on crude oil. All in all, not the best day, but the candle themselves and the chart pattern, definitely a positive factor for anybody who's long on crude oil. Here's your Dow futures, which had a really, we'll call that the meat cleaver kind of hammer. You guys might remember I was talking on Friday on how you have a hammer on most of the major market indexes, which could create some nice upside. Well, we were down for most of the session, and then you had your opportunity in the late part of the day to capitalize on a hammer break on the Dow, which was up 0.76% to 31,158. S&P, same picture. Right now, bouncing back up. We are 0.87% gain to 3924, which was another level I've been anticipating it bouncing right up to, and it did. NASDAQ, 1.01% gain again, following through on that hammer formation we achieved on Friday. Hopefully this will continue on. We get a little bit more momentum here for the markets going forward, which would be great. Maybe get us up to, I doubt we'll see these highs on the NASDAQ of 12,858, but it could. But I think we have a bigger obstacle, which is right around 12,232. Moving on to your final one, Russell 2000 just eked out the gains there. 1.09% gain for the Russell, making it your best performer, 1823. And it has also a very nice looking potential double bottom formation. Now, again, we don't know it's a double bottom. It's all about the follow through, right? A double bottom is typically a reversal pattern, but it could turn into a double bottom, a triple bottom, a quadruple bottom, and just call it a flat line. So always, yeah, thanks, KF. I guess I should solicit. You know, it's funny, a lot of these other YouTube channels, I think for most people, what they don't understand is all these other finance YouTube shows are generally pre-recorded, so they have all times to edit and solicit and say, click here, do this. I don't. This is all live every time we do it. So yeah, if you like it, hit that like button. That's your major top 7 marketplaces. There are other pieces out there which are rather important today. The dollar really didn't do much, although it does have a shooting star at the end of the day, which looks like the dollar may have some weakness here over the next couple days, which would be great. Remember, weak dollar, strong market. So let's, for those of us who are currently poised for the long side, look, I would love to see this dollar drift down a little bit. Heck, if we can get down to this 108, I'd be really happy because I'd translate typically to some very nice market gains out there. And lastly, bond market. Now, there's 2 things I want to look at here with regards to the bond market because that leads us right into anticipating the Fed's next move. Number 1 is, here's your 10-year. This is the daily of the 10-year, and I mean, beautiful. I mean, absolutely beautiful. It's just been drifting up and up and up and up and up. We are officially right at that number I talked about several weeks ago, saying I expected to get back up to these highs that it achieved here on June 16th, which is 3.5%. Lo and behold, we're at 3.494 right now. After this, we got to go back to a weekly time frame to see where that next level may be, and it is slightly higher. I mean, I'm thinking you're going to get to 3 3/4. After that, you got 4%. So you got kind of 1/4% steps here. We'll make sure to bring that back up with David since he loves quarters and halves, etc. But the trend right now is saying higher yields. Now, what's interesting is even though we're seeing the 10-year raise more significantly, it's the short end of the yield curve that's really doing damage. Here is the 10 versus this is the 10 and the 2. And notice now you can get almost 0.5% more by buying a 2-year versus a 10-year. But watch when I switch it over to the 1. This is crazy. Right now you can get over 0.5% more for buying a 1-year bond versus buying a 10-year. That is a very bad inversion, and it looks like it's accelerating right now. So this is obviously not good for the markets. It implies that the long end of the yield curve is not steepening as much as it should to stay a normal yield curve. It's just accelerating. The short end is rising quicker than the long end, and that's what we're seeing reflected here. So that is the main big stuff I wanted to cover before I got into this, anticipating the Fed's next move. Now, I could run poll after poll. Unfortunately, I don't have the time to type in all the stuff into chat and create a poll for you guys. But it boils down to what the heck is the Fed going to do? As I mentioned at the top of this, we really only have 3 choices. It's going to be 50, 75, or 100 basis points. And each one of those not only is designed to have an action on the market, but will tell us what the Fed is thinking about that market at that moment in time. So what I wanted to do is look at 2 separate charts here really to set the stage for what might be coming, and then I'll give my expectation, which I could be totally wrong, and again, my opinion doesn't really matter at all, but I mean, it matters to me because I will be positioning myself accordingly to my thoughts about it. So let's look at anticipating the Fed's next move. I'm going to start you off with the chart of the Fed funds rate versus PCE. Now, PCE, core price index, is what the Fed has been saying. This is what we're looking at as a result of inflation. Okay, there we go. This goes back into the 1970s, and you notice I believe it's It's like a red line and a brown line, I believe. I am colorblind, I apologize. But the red line, for the most part, is on top. That is the Fed funds effective rate. And I'm going to just use my drawing tools here so I can hopefully not screw the whole show up like I always do with my drawing tools. Come on. Nope, that's not what I want to do. All right, there we go. So back here in the early 80s, you can see the Fed funds futures was up at 19%. That's insane. But notice where the trimmed PCE was. Trimmed PCE basically means it's a slightly modified measurement of inflation, but this is what the Fed was looking at. What's interesting there is the Fed funds rate was aggressively higher, and this gap between the Fed funds rate and the PCE was high for some time. There's one spot on this chart that I look at and I go, wow, who screwed up here, right? And that is right over here. Notice that this is the only part of the chart where for a period of roughly a decade, we had inflation was significantly higher than the Fed funds rate. To me, this is part of the reason we're in the situation we are in. This was the straw that broke the camel's back. And of course, right here, we had one of the biggest bull markets we've ever seen, right? Why was that? Gee, it's because the money was at zero, right? Money was free to pretty much banks and corporations, and inflation was just slightly higher. So you basically fueled it. And the danger in this window that I have circled here is that that interest rates are so low that you're pumping so much money into the economy. We were saying back here in 2013, 14, 15, going, oh man, this is going to have a serious impact on inflation going forward. And it didn't. It just didn't. There was no real tip in inflation until COVID hit. Now all of a sudden we get this pop, like all the chickens came home to roost at the hard red edge. So that oval I've made, to me, is the real beginning of the problem. And now it's just how do we catch up with the problem that we created, right? The monster that's been created. So I wanted to set the basis of history because you can see that the norm is the Fed funds futures rate well above inflation. And you can see right now we're the exact opposite. So let me zoom in here. And this is what we've experienced since 2016. So if you look at the Fed funds rate, right, we're right here at 2.5, right, where our little circle is. And you can see that inflation, surprisingly, for the past month has come down rather significantly. Now, that's only 1 point data, but I think you see just lots of volatility in the inflation data on the high part of this chart. What's interesting to me is it's the first time we've really seen an aggressive pullback in inflation. Yet we're seeing an incredibly sharp rise in the Fed funds futures. Now, why is this important? Since my topic for today is anticipating the Fed's next move, in my mind, I only have two factors to think about. I've got this brown line here, which is inflation itself, and I have this red line down at the bottom, which is what the Fed funds futures are. And everybody's talking about the Fed funds futures. They're saying we are now going to be raising it to, I'll give you the high probability right now. The high probability is we're going to 3.25, which means we will now be up here. And do you notice what that does? That puts us pretty much right where inflation is according to PCE. Now, if inflation continues to drop and looks like this, then all of a sudden we find ourselves in a situation that we're much more comfortable with, meaning that the Fed funds rate is above the core PCE price index average, which in my mind, we'll have the Fed look at it and go, hold on a second. We've tamed this beast enough. We no longer need to be as aggressive. Now, how many of you think I'm completely out of my mind, or did that make sense to you? Yes, I'm out of my mind. You have to type the whole thing, or that made sense to me. Let me know if that made sense to you, because to me, this is critical. Everybody right now, the big money says there's an 82% chance that we're going to see a 75 basis point increase on Wednesday. And I personally, I think that's what they'll do. I think they really should do 50. I'm with Margaret. I think they should raise 50 basis points because notice the acceleration of this red line. I mean, it's really aggressive. Bring that one back up. It's been really aggressive, and it's not like this is gonna kill us, but it's saying we're so aggressive, and we're just starting to see the inflation not under control per se, but it's calming, right? We're finally seeing a little bit of a reprieve in it, which I think is going to signal the Fed like, okay, maybe we don't raise as much. And if they do raise 75, I think the next meeting is going to be 50. So I think it's going to go like this. There's 75 would be there. 50 would take us to there. And I think the next meeting by December, we stop at 4%. For me, it's important to understand that The Fed obviously wants to get inflation under control. But remember, the more that they hike, the more they raise rates, the more it chokes out the economy. So it's a slippery slope. And I think that the media has kind of been a little easy on it, meaning made light of the situation where you have rates increasing so quickly. But those rate increases that we experienced in June and July, those have barely even hit our market yet, meaning it takes time for a 75 basis point increase to hit the bottom line, to hit earnings, to hit GDP, to hit home building prices and all that stuff. That takes some time. So I'm looking at this chart right here, and this one says to me a very important about face in inflation. Now, it's only 1 month data, but my money says 75 for this current meeting, which will put us up to there, and after that, they'll reevaluate. And if we get inflation drops back down, we may see them stop. But that's inflation minus food and energy. I don't think that is. That's the trimmed mean. That's not core. I'm not 100% sure on that one. It's a good question, Tom. I'm not sure. It's not CPI, but I'll show you CPI here in just a second, which does include food and energy. So that's one piece. But here is another one I think is very interesting. Now, in this chart, what we're looking at is you're looking at the Fed funds rate, right, as a percentage. So right now you're looking at, we're 2.5 right now. And you subtract the rate of inflation, which is an interesting number to take into consideration. Now, you look at this goes back to 2000. We've been below it quite a few times, right? You can see here from really 2010. Where am I doing? Oh, here from 2010. This whole period of time we were down below it. We just started to peek our head above it, and all of a sudden we went aggressively down. Well, you notice we've also had a really aggressive move up. And of course, there's this ratio here is between the Fed funds rate and CPI, which does include food and energy. If it was core CPI, it would take out food and energy, but this has food and energy in it. Hi, Tom, that's the bigger question. That's really the biggest question out there is, am I really getting a good measurement or reading on inflation? Right? It says real world inflation is not 4%. I agree, it's not 4%. However, the metric that they are reading is telling us that it is. Now, that's a topic for another discussion. I mean, if I get politicians on here and talk about manipulating data, we'd all be blue in the face with just, give me the real answer. So yeah, I don't know what data is real or not. What I do know is this is the data that's presented to us by the Federal Reserve, which is supposed to be open and transparent, but I definitely would concur with you. That's probably not the real inflation rate of 4%, but it has been dropping, and we've cited why, right? We've looked at some of the reasons why. I've shown you tons and tons of charts of things like, we don't go bonds, but you've looked at the big decline, and this is a weekly, by the way. There's the big decline in cotton, and it's been falling for pretty much another month. The last month, almost straight. You see wheat has been aggressively sold off. Lumber, right? Lumber's significantly down. So are soybeans. Natural gas is the one strong one out here. And then you look at things like, you got your gold, your silver, and other components. But a lot of it's been falling. Crude oil is one I meant to take a peek at here. Look at the weekly of crude oil. I mean, it's been pretty much nothing but down since June. And of course, this is definitely having an impact on the inflation numbers. So, if this trend continues, and I'm a big believer that it will, simply because that's what the charts are telling us, then, inflation might continue to drop. And again, I don't know if the most recent interest rate hikes have had an impact. I don't know the economics. I don't know the balance sheets of companies to see, we've gone from, 50 basis points all the way up to 2.5. How's that hurting business? Well, we'll have to see what it looks like on earnings and forecasts going forward, but I would imagine it's going to start to hit here soon, and that may already be having an impact on the inflation number. So the reason I bring that up is expectations are extremely aggressive, and if I look at this chart, if these numbers crisscross, and that puts the Fed in a comfortable position to back off of raising rates, right, or at least slow down. Now, this is the other one, as I mentioned, the Fed funds minus CPI, and I want to look at this for two reasons. Number one is how aggressively it's sold off, right? We hit a low back here in 2022, just recently. It looks to be right around 8, maybe 8.5% difference between Fed funds and inflation, which means that inflation was significantly higher. But all of a sudden, it's bounced back. And of course, that has largely to do with the big increase in the Fed funds rate, but also the decline in inflation. So let's add on a longer time frame perspective here just to see what happens when this occurred in the past. Let me get some of this stuff off here. What I noticed was when you have it aggressively down below that zero line, like you do here back in the 70s, it was aggressively down and then all of a sudden it has an aggressive rip up. Same thing back here in the early 80s. You had a huge, aggressive, sharp move down and then it just absolutely screamed to the upside. So you notice I don't know, I'm a history fan, and I think that when you have the real sharp moves down, you get a big knee-jerk reaction. And I would contend that the picture on the hard right edge right now is that market ripping back. The question is, where do we go to, right? Do we get back up to this black line, which would be zero, meaning the Fed funds futures was right at the same rate as inflation? Obviously, that's what they would like, get those things back to normal. Don't know. I don't know. It's my gut tells me that we're going to see this move back to the upside and have a pretty significant run back up because of the Fed's aggressive actions and a slight slowdown in inflation. Remember, I'm not saying that inflation is over with. We still are going to have inflation to some extent, but maybe not as significant as it was before. Now, the final piece of the discussion is, it's not my opinion, it's the people who are putting money on the line. And here you go. I put this link in the chat many times. I think all of you should have this as one of your favorites. I actually love looking at this. I'll put it in the chat yet again for you guys if you'd like to have it. Yeah, I think it's important to keep this one in your favorites and just look at it every now and again. You'll notice that the forecast for this Wednesday's meeting show an 82% probability that we're going to see a 75 basis point increase and an 18% chance of a full 1%. Now, I think most would probably agree with the 75 basis point, right? I think that probably is where they will go. But remember, I believe the Fed right now has kind of opened themselves up to the possibility where they can do whatever they want. The Jackson Hole meeting was very pointed and said, be ready for some pain. People and businesses are going to feel some pain. You guys remember those exact comments. What will this rate hike do to the U.S. dollar? Okay, I'll get to that one. It's a good question, Paul. Let's look at it from the perspective of anticipation. Right now, the money, the markets have priced in 75 basis points. So when Jerome Powell comes out on Wednesday, like I believe he will, he'll say, we are going to increase 75 basis points. And the reason for that, we wanted to be more aggressive, but we have seen a turn down in inflation over the past, few months, and it seems like things are starting to normalize. Our actions that we've performed looks like they're starting to take a little bit of effect. So we thought about being more aggressive and go with 1%, but we think 75 is our appropriate course of action. I think that's pretty much what his talk track is going to be. And then he'll caution us and say, you know what? We are definitely going to keep our eye on inflation. We've seen it drift down, but that's never going to be, solid data. We need to have history of data there. So we'll be more aggressive should we need to be and use all the tools at our disposal to keep inflation under check and keep price stability. But as NJ says here, he's going to raise a full point. He absolutely could. He absolutely could. He has all the right in the world to raise 1 percentage point. I think the concern there is we've raised every meeting and we've increased every meeting, got more and more aggressive. We've basically been stamping on the brakes, but we haven't seen those impact yet. And if that comes and hits all at once, you could have all of a sudden a supermarket slowdown, which really crashes things. And again, that's speculation at this point. But I'm putting myself in the 75 basis point camp, but he'll caution us and say all these nice, polite things about why the market deserves only 75. My initial thinking was 50, and I personally, I think that 50 basis points is the right thing to do, given what has happened with inflation numbers, etc. I think by raising too much, you threaten businesses, you threaten unemployment, you threaten slowdown in the overall economy, which would hurt much worse. If the impacts are already starting to show a little bit of improvement in the inflation data, then you're like, okay, it's having an impact. Let's scale back a little bit and just see what these other rate hikes are now going to hit. If at 1% basis points, then what would the market do? I think the market would start to sell off aggressively. Number one, the market would start to sell off because basically what Jerome Powell would be telling the markets is, we don't feel inflation is slowing down enough. We need to be much more aggressive. By raising a full percentage point, it does what? The cost of capital for businesses that want to expand or bring on new employees or whatever, the cost of capital just went up by a full percentage point. There's a lot of people that won't be able to qualify at another 1 full percentage point with those rates. So, what was the other comment from Paul? Paul says, what would that rate hike do to the US dollar? Well, think about it now. The carry trade, right? If right now, let me see if I can draw it over here. Bear with me as I bring up my artwork tools. TJ, I wish you were here. I need my artwork tools, TJ. Let me add on a slide here so I can do some drawing for you guys, and I'll switch this over to there. Okay, now I got a slide I can draw on for you. Let's look at what we have right now, right? So here we have in the US, and let's just go to JPY, right? That's the Japanese yen. Japanese yen's at negative 0.1%. That's what they're at, negative 0.1. Okay, so 0.1%. The US right now is at 2.5%, which means that if I buy USD JPY, I will earn 2.6% yield. It's called the carry trade. Now, what happens if all of a sudden they go to a full basis point and go to 3.5%, right? Well, Japan's still at negative 0.1%, so what am I going to earn? 3.6%. So anybody who bought and is holding US dollars against the Japanese yen is now going to be earning 3.6%. So I will ask the question of you, Paul, what do you think this is going to do to demand for the US dollar? Sorry, 100 basis point is correct. Yeah, it's 100 basis points. I know what you meant. Yeah, 1 basis point, I don't even think they could do that. But Paul, what do you think would happen? What would happen to demand for US dollars if people knew, if foreign countries knew that they could get an extra 1% yield on their money just for holding USD JPY? Well, what it would do is it would cause the USD JPY, in my opinion, to surge. Because everyone's going to be going, holy crap, I'm buying USD JPY. It's the safe trade out there. I'm going to buy more of that because now I earn an extra full 1%. Yeah, that dollar's going to surge. Dollar's going to surge. So dollar's going to surge against the euro as well, which means that this chart right here, this is the inverse, right? This is the euro versus the dollar. That means more people are going to be buying US dollars, which would mean the euro sells off even more, which is great because I'm going to Europe for 2 weeks at the end of the month. So, hey, let's raise it. Let's raise it 500 basis points. That'll really help my my euro conversion rate when I go over there. But yeah, it's gonna cause demand for the dollar. Right? Oops. And if we look at that dollar chart, if this trend keeps going and keeps strengthening, this is going to be a big problem for the S&P 500, for the NASDAQ, for the Dow. It's putting pressure on it. And that's immediate pressure now. But what ultimately it means is the stronger the dollar gets, the weaker earnings are going to be. And we haven't started reporting our new earnings season yet. Heck, we haven't reported earnings this quarter yet, right? The past one, but the new one's going to come out soon, and this will start to have an impact on earnings announcements. And if that dollar keeps rising, those earnings are going to get worse and worse and worse. So it's a great chess game, if you will. One piece moves here, and then all of a sudden, oh, well, what's that going to do to the dollar? So if they raise rates on Wednesday, and that's a surprise, let's say it comes out at 1%, you could see this thing spike pretty significantly. I am still bullish on this. I still think that 113 level, which we mapped out a long time ago, right up there, 113.80, I think that's in play. And if we get to that 113.80 mark, I think that means a lot more downward pressure on these markets. Somebody sent me a video. Sorry if I forgot exactly who that was. I always like giving props. This is from Manuel. Manuel asked me to watch this video, and it was a guy from Guggenheim Partners. Great video, by the way. It's actually, I'll let me copy it and I will put it in the chat. Don't watch it now. Watch it after the show. But it's interesting, and I actually agree with this guy. I'm going to say 99% of what he says, I totally agree with. So there's the interview. In the interview, he asked him, says, well, what do you think is going to happen? He says, well, 75 is what the money is pricing in, but they could easily do a 1 percentage point. But he said either way, the markets are going to feel some pain. And he actually said a number that kind of shocked me a little bit. He said he expects the markets to drop by 20% by mid-October. Well, mid-October, look where we are now. Let's go to the S&P 500 and put this on a daily time frame. Mid-October is, wow. I mean, we're weeks away from, it's four weekly candles away. Right where my vertical cursor is mid-October. Down 20%. So what would that look like? Let's just have some fun here. I don't think that's going to happen. I think we're going to decline. I think going in October we're going to have a big sell-off. But here's mid-October, and let's just see what percentage that would be, or what it would look like to get down 20% from where we're at right now. Man, this guy, I think he's off his rocker personally. Hold on, I got to change this chart perspective here. Hold on 1 second. I'm going to change this style, and we will turn off the extend right. So 20% brings us down to roughly 3,100. To get there by mid-October, I think that would be a little much, but it could happen. I don't think there's anybody here that's going to go, there's no way that could happen, right? Certainly it could happen. I don't think that is where we'll end October or be in mid-October. That's a pretty significant decline, but you've got all these levels that we've mapped out here. Could it get to 3,200 by October? Yeah. I for some reason, I think we're going to see this market sell off into November and then all of a sudden start to rebound and have our end of year little positive move because of the calming of inflation. But I just don't know. I do think we are going lower, though. I just don't believe we're going to drop 20% by mid-October. That's a month away, and 20%, whew, that'd be some pain. But you're right, Margaret. October is historically the crash month, although the month that is historically the only month with a negative rate of return going back to the 1950s is September. So you got the only negative month followed by the big crash month. So it'll be really interesting. All I can say is this. Well, I can say a lot of things. Obviously, I do a show which is supposed to be 30 minutes and it's been over an hour every day pretty much for years. The guy in the interview made a really good point. He says, nobody really focuses on my company about all the great things that we do and great things that we call out. And he goes, internally, we don't do that either. Really, what's more important is the things that we sidestep. It's one thing to be a part of something that's great and capitalize on a nice big bullish move, but it's also great to sidestep disaster and sidestep pain points in the market, which I do think there's one coming. It's just, if Brendan was here, he'd be saying, don't fight the Fed, don't fight the Fed. And you're right. But I think you guys might remember last year, it might have been 2020. I think it was last year, where I was like, look, the Fed's backed themselves into a corner. They can't leave rates low as they are because inflation will all of a sudden absolutely explode. And they can't raise rates too much because it'll choke out the economy and we'll go into a massive recession. So it's like, it's this chess game. The guy in that interview also went on to say, and mind you, he's managing $300 billion. I am not managing $300 billion. I only manage my own money. And I don't have $300 billion. I wish. He says, look, either way, we're going to see significant pain. Doesn't matter if it's 50 basis points, 75, or 100, it's going to be significant pain. I was like, ooh, man. Ooh. What does Chris say? 20% is sick, but so far as we have pundits saying we test June lows 3,600, then we'll see 33, then 3,000. Yep. Yeah. We'll see. We'll see. It's tough. I have October 21 strikes on a bunch of puts that I sold, and I think I'm okay. But we'll see. What did Karen say? So do you think if they raise 75 basis points, the market will go up because it's expected? Yeah. I think what you'll get is the typical rate announcement action, which is this. It's going to move in a completely irrational manner. You guys all know that, right? When that announcement comes out, it's going to rip up and then scream down and then scream back up, and it's just going to whipsaw the hell out of you. Which is why I always tell people, wait at least 15 minutes after that announcement and let the market get some sense of direction. Now, what's noteworthy is after the rate announcement itself, Jerome Powell will be giving a press conference, and that's going to be 30 minutes after, which might be the best time to wait. Yes, you could leave money on the table, and some stuff might miss, but it's okay. If you've ever been whipsawed before, you know what I'm talking about. It's one of those ones where you see the Fed funds futures start to spike, or you see the S&P spike as the announcement comes out, whether it's good or bad, doesn't matter. You're like, I got to jump on this. So you jump on it, you hit buy long on the 10 contracts of the S&P, and you're like, yeah, baby, here we go. And all of a sudden, boom, it's snap of the fingers, and it just comes screaming back down. Now you're at a loss, and like, son of a, and you're hitting that sell button, you're getting out of those futures contracts, like, it's going down, I'm shorting. And you load up short 10 contracts, and all of a sudden it stops, rips back up, takes you, it's whiplash, man. Just save yourself the grief and sit it out and watch it with a bowl of Orville Redenbacher popcorn. Yeah, the conference is what's going to shake things up because we'll get his clarity on why he chose to do what he did. Like for me, as somebody that wants this economy to continue to thrive, here's what I would, in a dream world, what I want Jerome Powell to say. I'd like him to come out and announce at 11 o'clock on Wednesday, September 21st, this Wednesday, the Federal Reserve has agreed on a 50 basis point increase in rates. And when that happens, the market's going to scream up, going to rip up. And I want him to say, and of course this should be backed up by empirical data, that we're seeing inflation slowly decline, and we've been aggressively raising rates. So what we're going to do is we're going to slow down our raising of rates to see if we can calmly intersect the declining inflation, like that chart I just showed you. He probably won't do that because expectations and big money's backing him right now, and it's saying, hey, 75 basis points. So he'll probably say, we'll do 75 basis points, but I really want him to say something along those lines of, we're seeing inflation slowly decline. Our actions going forward most likely will be to slow down our rate increases to accommodate that decline in inflation. If in fact inflation does continue to drift lower and slightly lower, then we can back off and we will intersect those, and ultimately Fed funds will be above the rate of inflation, and then we can change our course. That's what should be said at this meeting. Of course, who knows? Who knows what on the world is going to happen? Exactly, NJ. Less stress, it's gambling. Just stay out of it. It's more about what his future view is. Correct. Exactly. And if he's, he could surprise the heck out of me and say, our data is showing that we need to maintain very aggressive approach. We're going to raise 1 full basis point, and the next meeting we could raise another one and be like, whoa, wow. Now, let me show you what the future kind of holds here, at least the expectations are, because I think this is interesting. Let's go out to December. So that's 2 more meetings. We have this one, and then one in November, and then one in December. Notice right now a fairly even distribution. We'll call it an 85% probability that we're going to be somewhere between 4.25 and 4.5. Right? So I think that's safe to say that we'll be somewhere between 4.25 and 4.5. Well, remember, here is September, and we're already we're at 250. So that's expecting a 1.75 to a 2% hike in the next 3 meetings. So if we get 75 here, then the expectations are another 75 at the November meeting, and then another 50 at the December. If he says anything that shifts these lower, that all of a sudden December, maybe this whole thing shifts lower and it goes to 4% or 4.25, then the market's going to have a nice rally because of that. Right? But it's all speculation at this point. We just don't know what the Fed is actually going to say. Going back to Tom's point earlier, inflation is way higher than 4%. Yeah, it's funny. I went to lunch the other day, and again, I told you guys, I go to Habit Burger. They just increased Habit Burger another 39 cents. And I was like, wait a minute, it was $8, like $8.40 in 2020, and now it's $11.68 for the same thing. I mean, no, that's way higher than 4% inflation. I'm with you, Tom. I totally agree. But I also think that this is usurious by a lot of the restaurants. A lot of restaurants just jack their price up knowing that people are going to buy it anyway. So, let's see. That makes sense, but I think maybe after a 75 basis point, he has to hold his stance right. Yeah, I think he does have to. He has to look confident that what he is doing is the right thing. He can't come across as wishy-washy, right? That would erode the confidence of the financial markets. He has to be definitive and very serious. That's why I liked what he said at Jackson Hole. I mean, he was very pointed. I told you that people will feel some pain, and businesses are going to feel some pain. They need to be ready for that. Like, that was like a gut shot, right? That caused a big drama in the market. Do you follow any news from Biden economic team on those subjects? I do not. No, I think that, I don't know. I apologize, but I hate politics. I think that they're all scumbags. I think the Democrats are scumbags. I think the Republicans are scumbags. In general, I know there's some great politicians out there. I think that for the most part, these elected officials go in there with altruistic motives to make America great. And that's not to steal from Donald Trump. It's just a mission of a politician should be to make their country great. And I feel like so many of them get in there and all of a sudden it's like, oh, wow. I now have access to information that can make me tens of millions of dollars in the market, and I can manipulate things and I can change bills to benefit my own personal financial well-being, and that's really what bothers me. It seems like so many of them have turned, and now I'm hearing about bills that didn't get passed because that politician that voted against this bill, which should be good for America, he voted against it because, he's got a whole bunch of shares of that stock. I mean, come on. It's terrible. I don't even know it's term limits. I think what you really want to make it a point, you make it illegal for any elected official to have any financial investments in the financial markets. You pay them well. You already do, right? You pay them well. But you make it illegal for them to have any investments. Anything. And yes, I know there's blind trust where they can put money in, but come on. Of course they're going to be telling the people what they're going to... Hey, could you put some Netflix in that portfolio, would you? Unfortunately, the only people that can make that vote would be the politicians themselves. So, probably not going to happen. McDonald's and their $1 any size beverage is so sad. Well, Michael, if you're really good, you keep your $1 cup that you bought and you just keep going back in and getting refills at every McDonald's you go to. I've got a McDonald's, a Wendy. No, I'm just kidding. All lined up in my car. Are politicians supposed to buy stock? They're not supposed to, but of course, I mean, look, Robert, if you knew, let's just say the infrastructure bill that went through, right? Trillions of dollars into the economy. And can anybody here, I'll give you $1,000 if you can tell me exactly where every penny of that almost $2 trillion went. Nobody here can tell me where it went. You can read the bill and say, it went to this place. No, that's where they said it was going to go. This is why we need blockchain technology. We need blockchain and smart contracts that would say, you're putting $100 billion into road improvements. Okay. Every withdrawal from that account has to come from a road improvement construction company. So I know at least it's going there. I think that there is, I'm not advocating theft, Mike. It was being a smart aleck. Well, NJ, you mentioned Pelosi, and she's an easy target, but there's a list of the money made. I think the top 5 people that made the most money that are elected officials were Republicans. Nancy Pelosi, I believe, was 6th. Doesn't matter. Again, I'm not making a Republican or Democrat argument. I'm making a point that these elected officials are self-interested, right? They'll go in there, with a net worth of, let's say, $1 million, and all of a sudden they come out and there were $200 million. Like, yeah, I served 8 years. Like, really? Wow. Political donors, influencers. I mean, yeah, if we had smart contracts and blockchain, we could see where every penny went. So when an elected official says, hey, we're going to give, $1 million to California firefighters, we could all log in and see that it actually went to firefighters, as opposed to, $200,000 went to the lobbyist and another $200,000 went to the guy who distributes the money, and all of a sudden firemen only get $100,000 out of $1 million. That's why I don't like giving to charities, because a lot of times charities are mismanaged. If you want to give money to somebody, give direct money to those people. Anyway, now you got me on a rant. Thanks a lot. The Inflation Reduction Act. Oh, man. Let's see. Where do we go? I didn't change the date on this bad boy, but I will go to this one. So let me, that's my rant and rave for the Fed's announcement on Wednesday. I think we're probably going to get 75 basis points. I'd love to see the talk track soften ever so slightly, but I don't know. If he should stay to keep the Fed looking good, create a tough stance, a very affirmative that 75 was needed, and then what we'll probably do, remember there's the should and probably. He should have a soft tone in my opinion, but he probably will come out and be hard and say, I'm doing 75 basis points. We've thought about doing a full percentage, but we're going to wait and see what the most recent inflation is. If we get higher inflation, then we'll go to 1% in the next meeting, and he'll be very pointed and aggressive that way. How do you take the blockchain out of a cryptocurrency? Well, remember, a cryptocurrency is dependent on a blockchain. A blockchain is not dependent on cryptocurrency. They're different things, right? Blockchain is the technology that stores all the data and transactions of a cryptocurrency. They're not the same thing. The cryptocurrency is generally the medium of exchange in that blockchain. But if you're just using it as a data storage application, you don't need a cryptocurrency on it. Yep, don't trust them either. All right, so let me go to this one real quick. If you guys have more comments and questions, let me know. It's always happy to talk more about it. But I want to get this Tom's question. Tom sent this one on he emailed me at TraderMerlin at Gmail. He says, how do you interpret green candles with big wicks, especially the top wick? This is a 5-minute candle on the SPX today, starting at 12:30. It filled a gap near the top of the pattern. I see these wicks as a sign of losing steam. Any thoughts? So here's the chart that he's mentioning, and I agree with you. What's noteworthy here when you look at this chart is, where do you see the preponderance of tails? Well, they're all on the top. Like every candle has a long topping tail here. So what it tells me is, while it is moving up, I agree with you, Tom, 100%. It is moving up, but it feels like it's losing steam because it should have been up much more. But for whatever reason, sellers kept pushing it back down. It tries to rally, sells off. Tries to rally, sells off. And even though they're all green candles, it feels like it's starting to slow down. And that tells me that people are selling off into this rally. When it goes sideways like this and then starts to make some new lows, then I'd be looking at that as a shorting opportunity. This is what I looked at all the time as a day trader looking at 5-minute time frames. Yeah, this thing's slowing down. And what I would do is I would simply grab my horizontal drawing tool, which I don't have one here, but and I'd say, we break here, I'm going short. Because you can feel it weakening. You feel it weakening there. And I know most of you are going to look at this chart and go, what do you mean? It's not weakening. It's getting stronger. Well, it is strong, period. But it's weakening because that selling pressure keeps kicking in and pushing it lower. If the sellers didn't come in here, these would be all gigantic green candles, and it would have moved much higher. So great question, Tom. I love this type of stuff. This to me is behavioral analysis of a price chart, right? It's simply just looking at what's the behavior going on with price. And while it is moving up and looking positive, it was showing that there's sellers coming in here, and if at some point those sellers are going to beat up the buyers. And I wish I had the regular chart here more. Let me see if I can bring up let's bring up the SPX if I have it here on a 5-minute and bring it over here for you guys. When was this? I don't have a timestamp on this bad boy. I'm trying to find the exact chart you got here. I thought it'd be like right in here. It may have. It's this part right here. And look what happened. So this is the chart that he sent me. Right, that's the chart. You can see this is the chart piece he gave me right there, just zoomed in. And you can see that it rallied up, had that little red candle, and then those topping tails. But what did it, again, just to my exact drawing I just drew for you guys. You go horizontal line. Say, okay, well, if it starts to make some new lows, you can put it there or below that candle. And boom, there's your short entry. You had actually a really nice follow through, and then it ripped back up. So, it wasn't a long-standing sell-off. But again, as a day trader, do I really care? No. As a day trader, I'm fine with a short-term sell-off. I just have to make sure I have my stop losses in place and lock in profits as that drops. So hopefully I answered that question, Tom. That's a great chart. Like that one. I see that stuff happen all the time where you can feel it slowing down, and all of a sudden it just gives and sells off aggressively. Great. Sell off. Let's see. I don't think I changed the date on this stuff. Maybe I didn't. Let me go to the economic calendar. I want to look at two things. Number one, let's look at what happened out there today. For the U.S., really nothing much. We did have the NAHB Housing Market Index. I know it's kind of hard to read, so I'll make it bigger for you guys. But there's the NAHB Housing Market Index. Came out worse than expected. So, I got to zoom in. It disappeared. It got rid of the numbers. What is going on here? Okay, there we go. I'll leave it right there. It was 49. They expected 47. Came out at 46. Remember, anything below 0 or anything below 50 means contraction. So notice what's happened here with the NAHB Housing Market Index. It's our second consecutive month below 50. Last time we had that was during the COVID pandemic when it first hit. And before that was going all the way back into 2014 sell-off and then the financial crisis. So it's only 2 points of data, but it is showing a trend where we've been really selling off on NAHB Housing Market Index going back into January. That's pretty bad. That's basically 8 consecutive months of declines in that, which means housing market's slowing down. Now, as far as tomorrow goes, here's your economic announcements for tomorrow. Lots of stuff going on. Canada has a lot to do with consumer price index. You see they have multiple variations of their CPI, the trim, the median, the common, core CPI. For the U.S., though, eyes are on building permits and housing starts. We are seeing the housing market slow down, so I'm surprised that they're expecting housing starts to stay the same. it would make me feel like this should be declining given what I'm seeing with housing prices and especially new home sales and existing home sales. But we have been seeing a decline here. So they're expecting it to stay the same. I don't. I expect this to come out lower. It would not surprise me to see this come out at like 1.2 or sorry, 1.4 or 1.41. I think you'll see a decline in those housing starts and building permits. So just something to keep an eye on for tomorrow. That's your big economic announcements for the U.S. The only other piece here is for the European Union. The ECB President Lagarde speaks. She's been rather critical on cryptocurrencies and stablecoins, so I'm curious to see how that might smack the crypto markets a little bit more as they're under a lot of pressure. But that comes out at 10 a.m. Pacific time. All right, what's the effect on the market? What's the effect on the market made it basing sideways? Well, it depends on what we're talking about. If you're talking about the NAHB, it's more about the long-term impacts, because if that confidence number in housing is declining aggressively like it looks like it is, then that means that the housing market most likely is going to start to decline. And because that represents about roughly 15% of GDP, an aggressively declining housing market could really bring down our GDP numbers. And now all of a sudden the Fed's really backed in the corner and we get that somewhat stagflationary environment. Now, if we don't find a solution to this, we are going to have those three components to stagflation here shortly, which is high inflation, declining GDP, and high unemployment. Now, right now, unemployment's historically low, but we just saw it start to tick up. And again, you're hearing more layoffs, et cetera. So curious to see how all these rate increases start to impact businesses. If businesses slow down and consumption starts to slow down, then by November, December, we might start seeing some data that shows unemployment surging. Then we've got a real problem. We'll have to wait till we get there. What's the effect on the market? With the NAHB, nothing at this point. I think it's just one of those check marks. Like if I have two columns and I say bullish or bearish on the S&P, the declining NAHB number, that's a big check mark in the negative column. Now it's not going to crash it today. I'd be looking more at inflation data as being inflation and GDP being more important than that. But if that snowball gets rolling with housing and it really starts to decline, then that would have a negative effect on the S&P 500 and the broad markets overall. All right, that's going to do it for me for today. I was told I was seriously going to try to do a 30-minute show today, but I just can't do it. You guys keep dragging me into hour shows. 52 minutes today. If you guys have comments, questions, feedback like Tom did about those candlestick formations, which was great. Thank you for that one, Tom. You can email me at TraderMerlin@gmail.com, but the easiest way is to put your comments down below any of the YouTube videos. I do check all the comments. I have a few in here that I'm researching for probably tomorrow's show. If there's something you want me to discuss for tomorrow's show, send them in as well. Go to YouTube channel, say, hey, talk about this tomorrow, get this guy on. Somebody asked about Ryan Watkins. I reached out to him. Hopefully in another week or two, we will get Ryan on the program. He's got a bunch of personal stuff he's working on, so hopefully we'll get through that here soon, and then I get him on the program. That said, hope you guys enjoyed today's show. It's going to be a really exciting week. I think tomorrow, most likely you're going to have lighter volume days until Wednesday, meaning tomorrow should be a lighter volume day as people go on, I'm just going to go hands off until the announcement comes out, and then the doo-doo hits the fan and things go absolutely crazy. So be careful out there tomorrow. Hope you guys have fun trading. I will see you on our Tuesday show. Again, email me, TraderMerlin@gmail.com if you got anything you want to discuss. Talk to you later.